So let's dive into the risks of owning equity in companies. So the first risk is capital loss. So the risk of capital loss is essentially where something may happen to that company and you may lose all of the money or the capital in which you invested. And now how likely that is depends on the company, the growth prospects, the industry, and all those kinds of things. And if you basically sell your shares for less than you bought them for, then that's your capital at a loss, right? So the second risk is volatility risk. What volatility is essentially is how fast price changes and how significant those changes can be. So when you look at stock market graphs, you can see that it changes and it varies a lot. And so you need to think about how long you plan to invest in it. The third risk is market risk. And so when we say market risk, this is essentially the risk of trading the shares with whatever else is happening in the market. Now, when we say market, we just mean where the trading is happening. And so what can happen is if a huge investor announces that they're going to sell their shares in a specific company, that can very much move the price, plus whatever else is going on in the market. So for example, when Kylie Jenner tweeted that she wasn't going to use Snapchat, or she doesn't use Snapchat anymore, that wiped off £1 billion worth of Snapchat's market value. And so these things, like, they're outside of the company's control and they're sort of driven by what else is kind of happening around us. The fourth risk is sector-specific risk. And sector-specific risk is associated with whatever sector that company is operating in. So for example, oil, right? So oil prices, falling oil prices could have like a huge impact on company shares like BP, right? And that might mean that the shares fall. So it all depends on the sector the company is in and what is happening within that sector. Another example of this is like Louis Vuitton, right, which is in the luxury goods sector. So if suddenly the way people perceive the luxury goods sector changes and people are not buying as much, then that can actually influence a company's share prices. Sustainable sort of clothing and like a lot of high street stores like Debenhams have announced that they are closing down stores, right? Meaning that not only will people lose out on their jobs, but that the company's profits are going down, and so essentially will their share prices as well. Yeah, and so that's a sector-specific risk because people are just, I guess, no longer interested in high street buying. The fifth risk is stock-specific risk, and stock-specific risk is particular to that company and their shares. So I guess a good example of this would be Tesla, because Tesla's share prices have kind of been here and there because of all of the things that have been going on with Elon Musk and his announcements, and I guess his behavior on Twitter has very much influenced the share prices because investors just don't know what's going to happen next, right? And so that's why it's stock specific, because it's influenced by things that are happening within the company as opposed to the outside world. So last but not least, the sixth risk is timing risk. And so market timing is essentially when you decide to buy and to sell. And market timing is something that you just can't control it, okay? So you're always kind of looking to buy at the lowest price and then sell at the highest price. However, market timing is not possible, okay? You can manage it to some extent, right? And let's say if you're following the company daily, you're looking at all of the news that comes out, you're making assumptions, you're looking at historical data and all of those kinds of things, then you can, to some extent, I guess, think about when would be the right time to buy and when would be the right time to sell. But it's just so happened that no one has ever been able to do it perfectly every single time, right? So that's just a risk that you need to be aware of and manage as much as you can. None of these risks can be eliminated. So these are all the risks that you need to be aware of when you invest money. Even when things look perfect, like nothing could go wrong, things could still go wrong, okay? And that's why diversification is like very important, because diversification, I guess, is the primary way for you to sort of mitigate those risks and start looking at investments that behave differently to the sort of investments that you currently have.